Ever pondered over the concept of real estate investment trusts, also known as REITs? Let's demystify this intriguing concept together. REITs are, in essence, corporations that own, manage or finance income-producing real estate. Now let's delve a bit deeper into this. You may have a desire to venture into real estate, yet the thought of owning an entire building, a shopping mall, or even a small real estate might seem a bit far-fetched, correct? That's precisely where REITs come into the picture. They serve as a bridge that allows everyday investors like you and me to pool our financial resources and delve into the realm of large-scale, income-producing real estate properties. It's all about the power of collective investment. By drawing together the funds of numerous investors, REITs can acquire properties that would be out of reach for most individuals. We're not just talking about residential properties here. These are vast commercial properties, bustling shopping and highly secured data centers, among others. The beauty of this lies in the distribution of ownership. Instead of owning a single property, you get a piece of many properties, each bringing in its share of income. Imagine a pie, with each slice representing a different property. As an investor, you don't just own one slice, but have a stake in the whole pie. Every time any slice of that pie generates income, you get your share. It's akin to having your real estate cake and relishing it too. Now that we've delved deeper into what REITs are, and how they allow you to pool resources for large-scale investments, you might find yourself wondering, how can one start investing in REITs? In the world of investment, numbers truly hold the reins. It's time to dive deeper into the comparison of REITs with other types of investments. As of September 2023, data from respected sources such as Nareit, Morningstar, and ETF.com collectively suggest a robust performance by REITs. What's particularly striking is the average return of REIT indexed investments, which have been total returns of 11.6% annually. Let's place this in context by comparing it with the Russell 1000. For those new to the investment world, the Russell 1000 is a widely recognized benchmark for U.S. stocks, consisting of the 1,000 largest U.S. publicly traded companies. It's frequently used as a barometer for the overall performance of the U.S. stock market. The Russell 1000 has returned an average of 6.29% annually. This is about half of what REITs have managed to deliver. This comparison accentuates the high yield potential of REITs, making them a lucrative option to consider for your investment portfolio. However, it's important to remember that past performance doesn't guarantee future results. All investments harbor risk, and it's pivotal to diversify your portfolio to manage these risks. Diversification is basically about spreading your investments across a variety of asset classes to avoid overly relying on any one source. It's a move to mitigate potential losses. In the upcoming section, we'll delve into the details of investing in REITs, equipping you with all the necessary information to make an informed investment decision. Venturing into REITs is more straightforward than you might envision. Let's navigate this journey together. REITs, which stands for Real Estate Investment Trusts, are typically transacted on renowned stock exchanges, mirroring the process of any other publicly traded corporation. They're not obscured treasures or elusive entities, they are right in front of you, accessible on the same platforms where you'd procure shares of your beloved tech company or index fund. To illustrate, the process of buying and selling REITs on major stock exchanges begins by creating a brokerage account. Then, you fund this account with the amount you intend to invest. After that, you search for the REIT you're interested in by using its ticker symbol, which is a unique series of letters representing the REIT. Once you've found the REIT, you enter the number of shares you wish to purchase and execute the trade. The selling process is quite similar. You search for the REIT in your portfolio, enter the number of shares you wish to sell, and execute the trade. But before you immerse yourself into investing, it's of paramount importance to conduct meticulous research. Just as you wouldn't purchase a house without scrutinizing its foundation, the same principle is relevant for REITs. Begin by examining the REIT's performance history. How has it progressed over the last 5 or 10 years? Has it demonstrated consistent growth? Has it successfully navigated through economic recessions? All these are critical questions that need clear answers. Next, delve into the types of properties the REIT specializes in. Are they residential or commercial properties? Are they concentrated in a specific geographic area or scattered across various regions? The responses to these inquiries could influence the REIT's performance and your potential returns. Following this, scrutinize the management team. Who are the individuals making the pivotal decisions? What's their track record in the real estate realm? A robust, seasoned management team can frequently be a promising indicator of a REIT's potential for success. Once you've completed your in-depth investigation, you're ready to invest. This can be accomplished via a broker, a financial advisor, or even a robo-advisor. Each of these routes has its unique advantages and disadvantages, making it crucial to opt for the one that dovetails with your investment approach and financial objectives. Keep in mind, investing in REITs is far from a rapid wealth accumulation scheme. It necessitates patience, comprehensive research, and a profound understanding of the real estate market. But with a great deal of diligence and a sprinkle of shrewdness, you could potentially relish steady income and long-term growth from your investment. Now that you're well informed about the process of investing in REITs, let's recap on some noteworthy points to remember. Delving into the world of real estate investing, specifically REITs, there are both potential gains and risks involved. Let's further discuss these key facets of REITs. One of the standout advantages of investing in REITs lies in the possibility of receiving high dividends. What does this mean for investors? Well, REITs, as defined by law, must distribute a minimum of 90% of their taxable income to shareholders in the form of dividends. This often results in a consistent flow of revenue for investors, making REITs an attractive option for income-focused individuals. Moreover, REITs represent a unique opportunity to invest in vast realm of real estate without having to physically purchase, oversee, or finance any property. This is akin to enjoying a slice of a delectable real estate pie without getting your hands dirty in the kitchen of property management. However, as with any investment, REITs come with their share of risks as well. Much like stocks, REITs are susceptible to market volatility. This means the value of your investment can swing up and down over time, and there is no absolute assurance of profits. Furthermore, REITs have their own specific risks. They are predominantly dependent on the real estate market, which can be cyclic in nature and highly unpredictable. A downturn in the real estate market can negatively impact the performance of REITs. As we have laid out the potential rewards and risks, it's crucial to remember that investing in REITs, like investment, necessitates thorough research and understanding. Always do your due diligence and ensure you fully comprehend what you're investing in. Ready to start investing in REITs? The first thing you'll need is a reliable broker. Today, thanks to digital technology, there's a sea of online brokers offering REIT investment opportunities. However, each broker comes with its unique set of strengths and weaknesses, catering to different types of investors. Let's start with Charles Schwab. It's a household name, famous for its robust platform and extensive research capabilities. Seasoned investors often prefer Schwab for their expansive resources and insightful market analysis. However, their platform can be quite complex, potentially overwhelming for beginners. Contrast that with Fidelity. Fidelity offers zero-fee index funds, making it a cost-effective option for those starting out. They also boast stellar customer service, ready to assist and guide novices through the process. However, their research tools may not be as comprehensive as other platforms, a potential disadvantage for seasoned investors looking for in-depth analysis. Interactive Brokers is another contender. Known for its low-cost, high-volume trading, it's a hit among active traders. This platform allows you to execute large trades at minimal costs, but it may not offer the same level of customer support as others, potentially leaving less experienced investors feeling unsupported. Meanwhile, TD Ameritrade shines brightly with its educational tools. Newbies to investing will find their tutorials and guides invaluable. However, their fees may be higher than other platforms, which could deter cost-sensitive investors. E*Trade, on the other hand, is a well-rounded broker with a comprehensive offering. It has for everyone, from beginners to pros. However, some users find their platform less intuitive, which may require a steeper learning curve. Bear in mind that there is no universal best broker. Your decision should be based on your unique needs and investment goals. So invest time in researching, compare the pros and cons, and make the choice that best suits you. Remember, the right broker for you is not about who is the best in the market, but who is the best for you based on your personal needs and investment objectives. Now, having zeroed in on the right broker for your REIT investment, it becomes crucial to delve deeper into the distinct types of REITs depending on their investment holdings. This exploration will provide you with valuable insight to help you make a well-informed choice in your investment journey. Firstly, let's discuss equity REITs. These REITs are by far the most prevalent. Their primary business is owning and managing real estate properties, and they generate income principally through the collection of rent. Equity REITs can hold a multitude of property types in their portfolio. Held contributes to the revenue of equity REITs through the rents paid by the tenants of these properties. Next in line are mortgage REITs. These REITs operate quite differently from equity REITs. They do not own real estate properties. Instead, they lend money to real estate owners or buy existing mortgages or mortgage-backed securities. Their revenue is derived from the interest that accrues on these investments. Essentially, mortgage REITs act as a sort of bank for property owners and real estate developers, earning money from the interest on the loans they provide. Lastly, we have what are known as hybrid REITs. As the name implies, these REITs amalgamate the investment strategies of both equity and mortgage REITs. They own a mix of properties and also invest in mortgages. This allows them to offer a comprehensive income package consisting of both rent and interest, providing a diversified income stream to their investors. Recognizing the type of holdings a REIT has is pivotal to your investment decision. Whether you wish for a steady income from rent or interest, or even a blend of both, there's a REIT model that corresponds to your investment objectives. Remember, every investment offers unique potential rewards, but also carries inherent risks, so thorough research is paramount before you delve into any investment. Let's delve deeper into the trading statuses of REITs, a crucial factor to think about when you're choosing the right REIT for your investment portfolio. The trading status is categorized into three main types. On one hand, there are publicly traded REITs. These REITs are listed on a national securities exchange, just like stocks, and are accessible for purchase and sale by individual investors. They provide the highest level of liquidity and transparency since they are openly traded, and their prices are available in real time during trading hours. This makes it easy for investors to know the value of their investments at any time. The downside, however, is that they are subject to market volatility, and prices can fluctuate wildly based on investor sentiment. Next, we have non-traded REITs. Even though these REITs are registered with the Securities and Exchange Commission, or SEC, they do not trade on national securities exchanges. They are typically purchased via broker-dealers, which provides a level of verification. Their major selling point is that they might offer high dividends. However, they are less liquid and valuation can be complex, posing challenges for investors when they wish to evaluate their performance or sell them. Last on the list are private REITs. These are neither registered with the SEC nor publicly traded. They are typically only available for institutional investors or high net worth individuals. While private REITs can provide the potential for high returns, they come with their own set of challenges. The risk is higher, and they offer less transparency, which can make the investment a bit of a gamble. Knowing the trading status of a REIT can help you make a more informed decision on your investment. It's vital to understand the level of risk, transparency, and liquidity that each type of REIT offers. Remember, your investment should align with your financial goals and risk tolerance. As we move to the next section, we'll offer some practical tips on how to evaluate a potential REIT investment. Having delved into the various types of REITs and their trading statuses, let's venture further into the realm of tangible examples. In this section, we will not only observe some of the best-performing REIT stocks in September 2023, but also uncover their growth stories. The aim is to offer you a comprehensive understanding of the kind of returns you can anticipate and the elements that shape a REIT's performance. We begin with our top performer, Diversified Healthcare Trust, which saw an impressive rise of 85.9%. Their successful performance can be attributed to their well-diversified healthcare portfolio that included profitable assets such as senior living communities and medical office buildings. They were able to adapt and thrive even amidst the changing healthcare landscape. In second place is Tanger, registering a growth of 56.1%. Tanger's success story lies in its strategic locations and a carefully curated mix of in-demand retailers, which have consistently attracted high footfall, leading to increased profits. Veris Inc. enjoyed a growth of 33.4%, thanks to focus on high-growth markets and a robust portfolio of high-quality apartments attracting consistent rental income. Service Properties Trust, with an upswing of 31.9%, benefited from their diverse portfolio of hotels and service properties which were well managed and offered consistent revenues. Lastly, Macaric, registering a growth of 31.4%, has attributed their success to their focus on premier mall properties in key markets that have consistently generated high rental income. However, it's imperative to understand that these soaring performances are specific to September 2023 and may not be replicated in the future. The real estate market is dynamic, and REIT performance can fluctuate based on various factors, including market conditions, strategic planning, and the quality of their real estate assets. So, prior to investing in any REIT, it is crucial that you conduct comprehensive research to comprehend the potential risks and rewards. We will delve deeper into this topic in our next segment, where we will equip you with practical pointers on how to assess a potential REIT investment. Moving on from individual REITs, we will now examine some of the strongest REIT mutual funds in September 2023. These funds offer investors a basket of various REITs, creating a well-rounded portfolio and dispersing potential risks. Firstly, we have Barron Real Estate Institutional, which has seen a growth of 13.1%. This fund primarily focuses on investing in real estate companies that show robust potential for capital appreciation, including those involved in the construction, development, and management of commercial and residential properties. Next, we have Barron Real Estate R6, also up by 13.1%. This fund's strategy is to invest in companies with favorable growth prospects across the real estate sector, including those involved in the ownership, operation, management, and financing of real estate businesses. We then have Barron Real Estate Retail, which has grown by 12.9%. Fund's strategy is to mainly invest in equity securities of companies engaged in the development, operation, and management of retail properties. Following closely is Alpha-Centric Strategic Income, which has risen by 12.7%. It predominantly invests in fixed income securities of entities in the real estate sector, offering a blend of income and capital appreciation potential. And finally, we have another Alpha-Centric Strategic Income Fund, up by 12.5%. This fund primarily invests in a diversified portfolio of real estate-related debt securities, including mortgage-backed securities and other structured finance investments. It is essential to remember that these performances are unique to September 2023, and past performance is not indicative of future results. REIT mutual fund performance is influenced by a myriad of factors in the ever-changing real estate market, and therefore, it's vital to conduct thorough research, understand the fund's strategy, and the REITs it holds before making an investment decision. Stay tuned as we delve deeper into how to evaluate a potential REIT mutual fund investment in our next segment. Exchange-traded funds, more commonly known as ETFs, are investment funds that are traded on stock exchanges, similar to individual stocks. They offer a way for investors to buy and sell a diversified collection of assets, minus the need to buy each individual investment. A specific type of ETF is the Real Estate Investment Trust ETF, or REIT ETF. In essence, these are ETFs that focus on investing in real estate through property ownership, mortgages, and other real estate transactions. They allow you to invest in a variety of real estate sectors in the US, all within a single fund, giving you an efficient way to diversify your portfolio. Now let's turn our attention to some of the best-performing US REIT ETFs in September 2023. Leading the pack is the Residential REIT Income ETF. Seeing an increase of 6.3%, this particular REIT ETF concentrates on residential REITs, thus giving investors the potential to profit from the residential real market. What makes it successful is its focused approach, investing only in residential properties that have proven to be a steady source of income. Next on our list is the Janus Henderson US Real Estate ETF, which managed to grow by 6.1%. Diversification is the key to its success. This ETF invests in a wide array of US real estate companies and REITs, spreading the risk and potentially providing a more stable return. Following closely is the US Diversified Real Estate ETF, which grew by 5.9%. This ETF, similar to the Janus Henderson, provides a diversified approach to investing in the US real estate sector, making it appealing to those who seek a broad investment scope. Lastly, we have the JP Morgan Beta Builders MSCI US REIT ETF, which has seen growth of 5.3%. It mirrors the performance of the MSCI US REIT Index, which includes publicly traded REITs in the US, giving investors a good snapshot of the entire REIT market. Its index-based approach helps reduce the risk of poor stock selection and provides exposure to the broader market. Remember, these performances are indicative of September 2023 and may not reflect future results. Investing in REIT ETFs can be an effective method to gain broad exposure to the real estate sector, but careful research and consideration should be undertaken before making such investment decisions. In our next segment, we will delve deeper into how to evaluate potential REIT ETF investments. Like any investment, REIT stocks come with their own set of advantages and disadvantages that you should be aware of before diving in. Let's delve deeper into the pros. First, REITs are celebrated for their stable dividends. The dividends are not just steady, but also regularly increasing, which can provide a consistent and potentially growing income stream for investors. Second, they typically offer high returns, often higher than many bonds or other stable income investments. In fact, over the long term, REITs have significantly outperformed many other types of investments, making them a potentially lucrative instrument for those seeking to grow their wealth. Third, they offer liquidity, as most REITs are publicly traded on stock exchanges. This makes them easy to buy and sell, providing a comfortable exit strategy for investors. Lastly, they tend to have lower volatility compared to traditional stocks. This doesn't just add a level of stability to your investment portfolio, but also helps moderate the risk of potential losses. However, there are also cons to consider. One is illiquidity, especially with non-traded and private REITs. These types of REITs tend to be harder to sell, which might make it difficult for you to exit your investment when needed. Another downside is the heavy debt. Often, REITs need to borrow money to acquire new properties, which can pose a high risk if the real estate market declines. This is because the value of the property might reduce, but the debt remains the same. Additionally, while REITs offer high income returns, they often have limited growth and capital appreciation. This means that the majority of your returns will come from dividends rather than price appreciation, which might not be suitable for those focusing on capital growth. The tax burden can also be high, as REIT dividends are taxed as ordinary income rather than at the lower capital gains tax rate. This could mean a larger chunk of your returns going towards taxes. Lastly, non-traded REITs can be expensive, with high upfront fees and ongoing management costs, which might eat into your returns. Understanding these in-depth pros and cons can help you make a more informed and strategic decision when investing in REIT stocks. In the upcoming REITs video, we delve into the process of evaluating potential REIT ETF investments. We will demystify key factors such as the fund's historical performance, the portfolio's diversification, and the expense ratio. Beyond that, we'll also cover how to assess management quality and the importance of market capitalization in your investment decisions. So gear up, because this comprehensive analysis on REIT ETF investments is coming up next.